Daily chart. One second, I want to check make sure the sound's okay. All right, so the daily chart, we've been in the tight bull channel for a while. We have a fairly tight channel here, buy climax late in a rally, and we can see that the market looks like the market is finding resistance near 6,700. We have a doji, market sold off and then rallied, so it's a trend line break. But that's a pretty disappointing bull bar. Do you really want to buy above this doji? Probably not. Would you buy on a stop one tick above this bar and put a stop one tick below? With the market being late in a bull channel that's gone on for several bars, this is not what you want to see. And I mentioned on the weekly chart that I think that this bar is going to get bad follow through. I think last week is going to find disappointment this week and next week. And it'd be better for the bears if the current bar is a disappointment bar as well. So today's Wednesday. We have 2 trading days left in the week. There's increased risk that the market sells off either tomorrow or Friday. And in a perfect world, the markets will sell off tomorrow, and that would start a correction down, testing the bottom of this bar. I'll say correction, it's really not a correction, but it would start a reversal down and a test to the bottom third of this bar and possibly down here. Doji bar, that's disappointing, increases the chances we go more sideways. But if the bears are lucky, maybe tomorrow will sell off, forming a strong bear bar closing on its low. But so far, week high one buy, not a great buy late in a rally, probably sellers above and at least sideways. The bears, they need to build more selling pressure. They're starting to do a good job, but lots of bars above the moving average. And so we may end up having to go sideways for a lot of bars, develop more selling pressure, and then we can test down to the September 2nd low. 5-minute chart. I want to say a few things. Well, actually, let's do this. So we'll start with the open. On the 5-minute chart, the market opened inside of this trading range. As I was saying, the market opened inside of this trading range, and I thought the odds were the market was probably going to have to get down to the 60-minute moving average. We've been on the 60-minute chart. We've been in a bull trend for a lot of bars, several bars through here. And we're getting really close to the moving average here. And I thought the odds were we'd probably test it and have to fall below it. And so right here, this is the moving average. We haven't touched it yet. And with bar one not being in the middle of the trading range with a lot of overlapping bars, you can call it a triangle, probably going to test down. But we may have to go higher first. But I suspect if we do, probably buyers below. But the buyers may not come in until somewhere down here. We have a decent sell signal bar on the daily chart. Not great context because of the tight bull channel, but I suspect the sell signal will trigger. And that means we're probably going to fall below the blue line at some point today. 3, bear breakout below 1 and 2. It's a bear breakout below a triangle. It's a bear breakout. The bulls are hoping it's just a higher low in the triangle, but consecutive bear bars, we may get a small second leg down. And instead, what happened? The market broke below the bottom of the triangle and sharply reversed up. What about buying the close of 4, betting on the reversal? 4 is a strong enough bar that we may end up going higher, but you're still buying in the middle of the triangle. And then you can see what happened. 5, the market rallied, testing near the high of yesterday's 77, almost to the tick, 75, 75, 75, 75. This is a perfect test to the tick. And then the market sold off, finding sellers. That's a strong enough sell-off that even though the signal bar below 5 is relatively weak for the bears, the context is good, and that makes up for the weakness of the signal bar. 6, strong enough bear bar. We may go a little bit lower. Trapped bears. You have trapped bears. You have trapped bulls who bought the low of 5. And it's easy to look at this bar and think, yeah, it's the middle of a trading range. You know, buy the close of 6, betting that this breakout point closes and that the market's going to rally back to the center of the range. But the problem is you have to think about momentum. The market rallied all the way up here and then immediately sold off. So it rallied to here, sold off, rallied to here, sold off. That's a strong enough sell-off that the market may need a second leg down. And if the momentum is strong, in other words, if 7 is another strong bear bar, that could really trap the bulls. And because of that, you'll have traders looking to see what the follow-through looks like on 7. And then 7 consecutive bear bars. Good for the bears, probably going to get a second leg down. But we have a tail on 6, tail on 7, breaking out below a lot of bars to the left with magnets below 27. 27 being yesterday's 27. That increases the odds that the market's going to fall below the 27 low. And then another bear bar on bar 8. Good for the bears, but body getting smaller at the moving average. I think it's a tough area for traders to be selling. But because it's a bear breakout below this triangle, the first reversal up may fail and lead to sideways trading. 9, we have a doji, probably sellers above 9. But because of the hesitation, we may get a deeper pullback than what the bears want to see. And then outside down, 10. Second leg down was likely after the 3 consecutive bear bars, 6, 7, and 8. Second leg down, but not a great sell below 9 and not a great breakout on 10. Tail below the bar, possible fail breakout below the 27 low. So we may pull back. Whenever you have a stop entry, it's really common. You know, this low is a stop entry on the daily chart right here. Whenever you get a stop entry that triggers, it's really common for the market to bounce for a couple of legs and then try again to sell off. So that may be what we're getting here. The sell off down to bar 9, it looks like a bear leg in what will become a trading range. It looks like a leg in a trading range. It's a second leg down from yesterday's bar 74. That both of those reasons increase the odds of a bounce. However, the sell-off down to bar 9 is also tight. It's basically a micro channel with the exception of bar 9, the inside bar. So that makes me think probably a bounce, but the channel down's tight and there's probably sellers above. 10, another inside bar. Looks like we're probably going to get the bounce and then reversal. And then 12, another bear inside bar. So we have consecutive inside bars, possible final flag below the bar, and then a reversal up. But this channel down is tight, and that's a reminder that the bears are a little bit stronger than the bulls. But the market is at support, and I suspect there's bulls buying and scaling in. We're below the 60-minute moving average here, and the market can easily fall 10 points before the market finds buyers. So just like here on the 60-minute chart, it's common enough for the market to fall a lot further than what seems reasonable. At this time, the market was around, the moving average was around 61 even. And this isn't accurate completely. It's just a close enough reflection. So it's about a point off. But the market was at 60. The moving average was at 61, and the market went down to about 50. So it went 11 points below the moving average and then bounced. And that's fairly common. So I suspect buyers below 12, week low 1, outside up 13. Good for the bulls. However, there's sellers above 12, sellers above 11, and we may end up going sideways. What about selling the close of 13 or below 13? No way. Probably buyers below. And then bull bar, inside bar 14. Good for the bulls. Probably going to bounce and test. And test up to the 10 high at a minimum. And then the market tried to rally, and instead of getting there, it found sellers above, and we reversed back down. We have a strong bull bar, strong bear bar, lots of overlap, increases the risk that the market's in a trading range. And then we found buyers below 15 and reversed up 16. 16, you call it a second entry buy, but tail above the bar. You have some bulls. You have some bulls who bought above 14 or on the close of 14, scaled in lower, and what are they doing on the bounce? They're trying to get out break even. And the bears know that, so the bears are selling near the 14 high. Not a great buy, 14, but trading range, you have to respect it. We still may get a bounce, even though this sell-off might be strong enough that the market forms a trading range and gets another leg down. That's always possible. And you can see what happened. 15 was a bear bar closing on its low. The market pulled back on 16 and got a second leg down on 17. And that second leg was a failed breakout below this trading range, and the market reversed up. That's a good bar for the bulls. Big outside bar closing on its high. But the danger for the bulls is that you're buying high in a trading range. But I suspect it's probably an okay buy for at least a small second leg up. And therefore, bulls, it's probably not going to immediately fail. And instead, the market rallied, and you can see what happened. The market rallied, triggered the buy above 17, tested the moving average and the high of bar 8 at the top of the channel, and then started to sell off. So a lot of those bulls, had they bought above this bar, it's not unreasonable to exit on the way down or exit below 17. 17, you can call it a wedge top. We had a decent bear bar below 15. We broke above it on the 15 high during 18 and found sellers. I suspect we'll probably test the 15 low at a minimum. However, it's probably buyers. Bulls buying here, buying more lower. I suspect they're going to make money, but not a great buy below 18. 18 is probably a strong enough bar. It's probably not going to immediately fail. And you can see the market rallied, testing near the close of 17 and then sold off on 19. Consecutive bear bars, 18, 19. Is that good enough to go lower? Probably, but the overlap on 19 is disappointing. 19 overlaps 18 by a decent amount, and it's a warning that it's a channel on a smaller time frame. And look what happened. The market sold off, rallied on 19, sold off, and then rallied on 20. So it's a 2 or 3-legged sell-off. Just like the bears who sold below 15 and scaled in higher above 15, the bulls who bought above 17 and bought more below 17 looks like they're probably going to make money. And surprise, surprise, the bulls who bought above 17 and bought more lower made money. (2021) consecutive bull bars, but just like we had a big bar 18 and then a big tail 19, we have a big bar 20 and then a big tail 21. That increases the odds there might be more sellers up here. But because of the consecutive bull bars, we may end up testing the high of 18 and trying to break above it. And therefore, for the bears, it's better to wait for at least a small second leg or at least a pause. 22, we have a pause for the bulls. Good for the bulls. We have a pause and therefore a sign of weakness by the bulls. You have some hesitation up here. Bears, would they sell? It's 3 consecutive bull bars, but we have a tail 20, bar 20, tail 21, tail 22. Increases the risk that we go more sideways here. And then 23, strong reversal bar. Strong enough bar in surprise that we'll probably get at least a small second leg. And because of that, I don't know how many traders are going to be interested in buying. I don't know how many traders are going to be interested in buying above the 24 high. 24 is following 23. And even if 24 is a bull bar closing on its high after 23, 23 probably still needs a second leg down. And then you can see what happened with 24. Everybody sold it, and that's why the market sold off sharply. 24, strong breakout below several bars to the left, possible expanding triangle from anywhere over here. Here's the highs, here's the lows. So the market is expanding, the range is expanding, but that's a strong enough sell-off that there's trapped bulls, and therefore the first reversal up is probably going to be minor. 25, bull bar closing near its high, but after the consecutive bear bars, 23, 24. 1 second. As I was saying, consecutive bear bars, 23, 24, but strong enough 25. 25 strong enough for a bounce, but because of the consecutive bear bars, 23, 24, whatever reversal up we get might be minor. And then on 26, the market reversed down, forming a low 1. Now we have a breakout pullback sell, 26, but following a strong bull bar, 25, near support, these lows over here, and below the 60-minute moving average. I don't think that's really all that great of an area for bears to be selling. We still, that's a problem for the bulls because that increases the risk that whatever reversal up we get will retest the low 1 on 26. 27, outside up, good for the bulls, but An outside bar is an expanding triangle. I say that. And the range is expanding on these past two bars. Outside bar, but probably sellers somewhere above the 26 high. Really not ideal for the bulls to be buying above it. And then you can see 28, bears who sold below 26 and then sold more above the 26 high, disappointed with 27. They saw 27 as being a fairly strong bull bar. A lot of those bears bought back their shorts in the bottom third of 27, betting on at least a small second leg up. And then instead, the market formed a bear bar. That bear bar allowed the low one short bears out of their trade. The bears who sold below 26 and scaled in higher. And then bull bar 30, second leg up after 27, good for the bulls. And this just really becoming difficult to trade. On a day like today, when you have all these overlapping bars, it's really better to fade the strong bars. When you see a big bull bar, you sell it. When you see a big bear bar, you buy it. And all the way through. One of the things I measure, just kind of as a side note before I forget to say it, one of the things I'm always measuring is overlap. I pay a lot of attention to the bar and how much the bar overlaps the prior bar. And if the bar overlaps the prior bar by a lot, then it is a warning that the market is more of a trading range bar, and there's probably going to be traders fading it. Big bull bar 30, good for the bulls, but overlap by the prior two bars increases the risk that there might be sellers not far above. But 30 might be enough of a surprise that there might be buyers below 31 if it's a bear bar. And 31 instead formed a bear bar closing on its low. That's a little bit of a problem. It's three pushes up. We rallied on 25 into the 26 high, sold off 27, rallied 27, 28, sold off 29, rallied 30, and during 31, sold off on 31 and closed on its low. That increases the risk that the market may go lower. And then 32, we formed a pretty big tail above 32 in relation to the body, even though it closed on its low. And that's not a strong entry bar for the bears. That's a sign that 32 went up where it did and then sold off. So the market rallied and then sold off. So it's already two legs. Bear bar 33, but because of what I just mentioned about 32 and 33 is not a strong looking bear bar or bear trend bar, that actually increases the risk that the market is going to find buyers not far below. For 34, doji, probably buyers below, scaling in lower. Bears, they want a second leg down after 23 and 24. Bulls, they need the reversal. And then 25, doji, momentum weakening. That's good for the bulls. Increase the risk that we find buyers. One of the things that's important to note is that the market is spending a lot of time below the moving average. Even though the sell-off is weak, it's still a sign of strength by the bulls. And you have to wonder, why, if the bulls are so eager to buy, if the bulls are eager to buy, why are we not getting strong buy signal bars? And why aren't the strong buy signal bars getting followed through? That's because the bulls are hesitant to buy. They're not confident that the market's going to go a lot higher. And then we finally got a bull bar 36. But look at the bar. 36 failed to close above 35. It's fairly small compared to the prior bar. And most of the bar overlaps the 35 doji, bar 35 doji. That increases the risk we go more sideways. And then 37, a little bit of a surprise. We may get a small second leg down, but I suspect there's probably more buyers down here than sellers. And then you can see we got this strong bear breakout, 37, 38. Isn't that a bear breakout below the bear channel? 1 second. Isn't that a bear breakout below the bear channel? Yes, but you have to understand the overall context. We have a bear breakout here, sideways, and then a second leg down. We also have a bear breakout here, sideways, another breakout, sideways, another breakout. This might be a bear breakout below a bear channel that fails. In other words, we look at something like a 60-minute chart, or better yet, a 15-minute chart. It's probably easier to see. something like this. We have a bear breakout sideways, another bear bar sideways, another bear bar, and then finally a large climactic second leg. But this is a strong enough breakout that the first reversal up is probably going to be minor. When you see a bar like 39, you know that that's a big problem for the bears. And even if we fall below the 39 low, there's probably buyers below the 39 low. Plus, the market is at support. I made the comment the 60-minute moving average is up here, and we tested it for the first time in a lot of bars. This is the 60-minute chart, and the blue line is this same dashed moving average on the 5-minute, and we broke below it, and that increases the odds that we're going to test it, which we did right before the report. Bull bar 39, I would certainly get out of longs above the bar. It failed to trigger. The bears got a second leg down 40, but probably buyers below the 40 low. Not a good sell below 40 or below 39. Bull bar 41, but disappointed bulls bought the 39 close, disappointed 40, some getting out break even. I still think we're probably going to form a bottom here and test up to the 37 high at a minimum. And we'll probably reach yesterday's low, the blue horizontal line, around 61.75. Bear bar 42, but not finding strong. We're getting more overlap, and that increases the odds of buyers below. And then reversal up 43, good for the bulls, probably going to go at least a little bit higher. Weak follow through 44, but probably buyers below. And then 45, deep pullback, but the market found buying. And then a stop and true buy 45. Not a great buy above, but I think the context makes sense. And I suspect that we have a bear breakout and then a pullback, and the bears want the bear flag and trend resumption down. But because of the context, I suspect that this bear flag here is probably instead going to try and get a bull breakout of the bear flag. And that makes me hesitant to be selling. And I'm really only interested in buying at this point. And then weak stop entry sell 46, so probably buyers. And then 47, we have a micro double bottom after the breakout. 43, micro double bottom. Okay, entry bar 48, probably buyers below. And then we broke to the upside 49, followed through 50. It looks like we're going to go a little bit higher. But we have a tail 49, and then we rallied 50. So the market formed a bear flag here. It broke to the upside, pulled back, and then got a second leg. That increases the odds that we'll get bad follow through on either after this bar, 51 or 52. And then 51, we reverse down, strong enough bear bar. We'll probably at least get a pause and a small second leg, but the channel up is tight. It's a 4-bar bull micro channel. That lowers the probability of buying below 51 or selling below 51. 52, not a great entry bar, increases the risk that bears will buy back their shorts for the small loss and bulls will buy. And then you can see what happened if you sold below 51 at 57 even. We got bad follow through, and the market went to it went 2 ticks below your entry price. You could have gotten out without a loss. If you sold here, disappointed here, could have gotten out break even. And then outside up on 53, good for the bulls, probably going to go a little bit higher. And at this point, this is the start of the FOMC. And if you remember this bar, 10 seconds left in the 10 seconds before the report happened or the bar closed, the market rallied really quick. And so it's a sign of strong momentum in trap traders. So we're probably going to go higher on the report. And then we got this really big bar. That's such a big bar. And it's bad context near the all-time high, which is this red line. Probably not going to go that much higher. And that increases the risk that the pullback could be deep. Strong bear bar, really not what you want to see. One of the problems with buying, one of the problems with this bar is you can't just buy below it. And the reason is, hard to see, but if we go to a 1-minute chart, this is it right here. This is 1310. Let me see if I can do this in a way where it's easy to understand what I'm saying. Okay, so the market rallied during this bar right here, bar 55. And if you remember, bar 55 went up and then actually pulled back to, I think, around 65 even. And then the market actually rallied and closed higher than the extreme, which you can see right here. The market rallied, pulled back deep, and then it rallied, closing above the high and the extreme. And because of that, it's already a second leg up on a smaller time frame. And when the market formed this bar closing on its high, you form this doji. And so this is basically a parabolic wedge. 1, 2, 3. And that's in part why the market sold off quickly. When traders saw the first bar, the open of this bar is 13.5 to 13.10. So the open was this bar right here. So this bar, this is the close of bar 54. This is the first minute of 55. This red, this doji. This is the second minute. So in the second minute, or by the second minute, the market was all the way down here at 76 even. That's a strong amount of momentum in the first 40% of the formation of bar 56. And when traders see that momentum down, they're not going to buy until the market starts to stall. You can see strong momentum down, reversal up, and then pull, and then we got a second leg, and then a bull bar, but no one's going to buy that. And then that's in part why the market started selling off. The point I'm making, though, is when this bar starts to get too big, traders are going to be hesitant to buy it. They're going to see it as a failed breakout, and the reversal down on bar 56, the big bear inside bar, is being strong enough for a second leg. But because it's an inside bar, that increases the risk that will test back to the breakout point, the 55 low. You also have trapped bulls. They bought the midpoint of this bar somewhere in here, and then they're scaled in lower. So you know we can get a deep pullback if you're a bear. But okay, sell, betting on a second leg down. And then we got a big surprise 57. What about selling 57? It's kind of like buying the close at 55. It's a lot of risk. 45, the entry price is 46 all the way to 85, 86. That's about 40 points, give or take. And that's basically the entire day's range in 2 bars. It's really not, it's pretty dangerous. Plus, the daily chart is so bullish that whatever sell-off we get is probably going to be limited without at least going sideways. 58, bull bar, but probably more profit taking than selling, but it's still enough of a surprise. We'll probably get a second leg to the upside. And then we got a minimum for a second leg up. 59 sold off, testing below 57, allowing the bears who sold the close of 57, disappointed 58 to get out break even. And then the market closed on its high, 59. So for the bulls, it's 2 legs up. Rally, pullback, second leg up. That's good for the bulls. I suspect we'll go a little bit higher, maybe go above the 57 high. Why? Because it's a trading range, and trading ranges go above and below trend bars. And we got really close to the top of the 57 high with 63 consecutive bull bars, 60, 58, 59, 60. Strong enough breakout, probably buyers below in a second leg. But the rally to 60 is also a parabolic wedge on a smaller time frame. The market sold off to 58, rallied to the 58 high, sold off 59, rallied to 59, sold off to 60, rallied to 60, and that creates a parabolic wedge top. Increases the chances that the market pulls back. Plus, we have this strong sell-off, 56, 57, that may have to get a second leg down. 61, strong bear bar. Good for the bears, probably going to go at least a little bit lower. And then you can see traders bought, sold 50% pullback of 61. Consecutive bear bars, 61, 62. Good for the bears, probably going lower. But I suspect there's probably buyers somewhere below the 58 low after these 3 bull bars. And then pause at 50, 63. That pause is an end to the breakout, 61, 62. And therefore, we'll probably need at least a small second leg down after 61 and 62. And then you can see what happened. The market sold off below 63 on 64 and then reversed up. Not a great buy on above 64, but we could easily find buyers anywhere. The bottom of 64, the bottom third of 64, below 64. And then we got this surprise breakout on 65. But 65 is becoming more climactic. It's making the channel more parabolic, and that increases the odds of buyers. 66 strong reversal up, good for the bulls. Second leg up likely, so traders will buy, bears will exit. And 67 follow through, same thing. 68 testing near the close of 60, but probably profit taking and a pullback. But even if we do find profit taking, I suspect there's buyers and we'll get a bounce outside down, almost outside down 69, but probably buyers below. But we may need a small second leg down before the bulls can get the rally. And then we basically just went sideways for the rest of the day. This was enough disappointment following this big sell-off that it led to sellers at a new high. But I thought the micro channel 68, 69, 66, 67, 68 was strong enough for at least a small second leg up. For stop entries, I thought, maybe sell below 6, sell below 7, but really tough when the market's in here. And you probably just get out anywhere above any bull bar, get out below 4, get out above 14, get out above 16, and then maybe you sell below 18, betting on a wedge, 13, 15, 18, but decent buying pressure. If you sell below 18, you really want 19 to be a strong bear bar closing on its low. And then 20, reversal up, good for the bulls. You can buy it, but bear breakout, trading range, this may lead to trend resumption down. But if you do buy, you got to recognize this rally, 20, 21, 22, is the same problem as this rally right here, 58, 59, 60. It's got a lot of overlap. And that increases the chances that it's a wedge. Sell off, rally, and then sell off, rally again. If we reverse down on 22, it's a wedge top. So a lot of bulls will see 21 as a minor reversal, and then they'll be quick to exit when they see 22. Bears, they can sell below 23, but really tough after you see 25 and 27, or even 30. You're probably going to get out of your shorts. And then bears, they can sell below 26. I would not. And then maybe they sell below 31. I thought that was reasonable, or they can wait for the follow through, 32 or 33. And then some bulls will get out above 36. Some bears get out above 36. Other bears get out above 39 or above 42, definitely above 43. Give me just 1 second here. Bulls, they can buy 43, but then they probably get out below 51, and then you got to wait for the report. And at this point, I think these are too difficult of stop entries. You're not going to buy above 54 is dangerous, 55 is dangerous, and then maybe you sell 56 if you're really aggressive. But then you got to take profits down here. It's basically a large expanding triangle. It doesn't look like it, but pretty much is. The range is expanding. Strong enough bear breakout, probably sellers above, but the sellers may not come in until somewhere up here. Bears, they can get out above 58. And then bulls, if they buy, they probably get out somewhere as the market's going down. Trading stop orders in here is really, really difficult. If you sell below 61, you got to get out somewhere down here or when the market starts to reverse up. And that is the question. And that's the hard part about stop orders in this kind of environment. And then 66, reversal up, strong enough bar, probably going to go at least a little bit higher. And then we rallied up to here, but now we have a wedge, 1, and then 2, maybe 3 pushes, 1, 2, pause, 3. And then we reverse down, 69, not a good sell. And that's pretty much it for stop orders. Limit orders, I thought probably sellers above these bars, but they never triggered. And then at this point, I'd rather buy below bars because of the moving average that I mentioned. And then I thought probably sellers above 28, betting on a second leg, betting that we'd test back to the low 1, but tough to do. And then I thought buyers anywhere down here, especially if you need some wide stop scale in. So buyers below 39, buyers below 41. For me, when I see 39, I'm not going to sell above it. And therefore, even though 37, 38 are strong enough for a second leg, because of the context, and when I see 39, really don't want to take that trade. Probably buyers below 44 during 45, and that's probably it. You can buy below 46, but tough to do. And then here, this is really difficult limit order trading. Maybe if you understand what's going on, you can sell the 57 high during 60 or 61, betting on a second leg down. You can buy below 63 or 64 if you can use a wide stop, scale in. If you need a pretty wide stop, you can buy the close of 69 or buy below 68 for a bounce, and maybe sell above 68 when the market starts to hesitate. That's probably okay. And that's probably it for limit orders. Buy the close, sell the close. Not really any good buy or sell the close during this part over here. Maybe sell the close 7, but it goes sideways. And then, not really a great sell the close here. If anything, I thought 38 was more buy the close than sell the close. And then, maybe buy the close 54, but that's the report bar. You're not going to do that. And then I thought, maybe sell the close here on 56, but not great. And then sell the close 57. No, it's probably more don't sell the close, wait for the pullback to fail, and then sell, and then sell. And then not buy the close in here. Not great, sell the close here. It only goes down for a small second leg and then reverses. So you can buy bull bars like 66, but it's not really all that great buy or sell the close. Let me take a look at some questions. I realize I never turned the question box on, so I'll give that a couple minutes. As far as tomorrow, I think we'll have something disappointing. Maybe a weak high one buy. We have a weak high one buy, so probably not going to find strong buyers. Probably not going to find a lot of buyers above this high. And even if we do go above its high and above yesterday's high, there's probably sellers somewhere above. And I still think Thursday and Friday, bears want to get the reversal down. Bears want the reversal down, and they want to close the breakout point this high from 2 weeks ago, September the 5th, and the current week low. All right, so I'm not seeing. Let me scroll through Discord. Not seeing any questions yet. So I'll give it about 30 more seconds, and then I'm going to wrap up the review. Okay, question. How is an inside bar on a trading range day different than an inside bar on a trending day? Well, an inside bar is always going to be a contracting market. And so it's always going to be a trading range day. It's always going to be a trading range on a smaller time frame. And therefore, I think of every inside bar as a trading range. And therefore, you think it's, every trading range on any chart is either going to be a pullback or a reversal. So let's find. Let me just find, it's hard the scaling throws it off. So let's just go back. So you can see, for example, we have an inside bar. Okay. We have an inside bar on 18 on this day, the September 15th. This inside bar is following 3 legs up, 1, 2, 3. So an inside bar is a trading range bar after a breakout. And this inside bar, it's actually a consecutive inside bar, 17 and 18. So we had a breakout 15, then we have consecutive inside bars. So it's a triangle, and that's breakout mode. So the market's deciding, is this breakout strong enough to get a second leg, or is this pullback going to lead to a reversal and reverse the trend? So the more the market's in an overall trading range, especially late in a trading range, the greater the risk that the inside bar fails and reverses. On the contrary, if you get an inside bar in a really strong trending environment, so here's a bull trend, strong breakout above all the bars to the left, and now we have a bull inside bar right here. I say it's not a bull inside bar technically, but let's find an actual inside. Okay, here's an inside bar, bar 18. Typically, because inside bars are always high ones and low ones, in this example, bar 18 is a low one short. The channel down is tight. The general expectation is buyers below and a bounce, but the bounce might be the upper third of the bar, and the bears are controlling the sell-off, reasonably well, and that led to the second leg down. If we look at, I'm trying to find I want a strong breakout with an inside bar. Here's one. We have a strong rally. And then the market went sideways, formed an inside bar 18. This is trending behavior. The inside bar late in a high in the range compared to the bars over here. But this trend is strong enough that the expectation is a pullback and then trend resumption. And that's because it's a trading range. The market breaks out above the trading range. Bar 18 is a trading range along with 17 and 16. The market breaks out above it and then pulls back into the range. But ultimately, the range becomes a pullback in an overall trend. Let's find an actual inside bar. So here's one. Gap down and then a bear inside bar closing on its low. The typical expectation is a buyer's below and at least a bounce. But because this is a breakout with follow through, gapping below bars to the left, that increased the risk the market sold off. Inside bars, I always think of them as high, basically in the bear trend, I always think about them as low ones. So when I see an inside bar in this environment, I'm selling. It's like this bar on 7. I don't care that it's a bull bar. The market rallied, pulled back, rallied again, pulled back. That's 2 legs up on a smaller time frame. That's a sell the close bar, sell below the bar, sell during the breakout kind of bar. So that's how I think of inside bars. Here's a bull inside bar, bar 11. But bar 11 is following a large bull breakout, 7 high in the range. That's a weak high one buy, and therefore sellers above increased risk of reversal down. So inside bars are very context dependent. All right, looks like that's it for questions. Thanks everyone for hanging out, and I will talk to everybody. I believe I'm in the room again on Friday, so I will see everybody again then. All right, thanks everyone for tuning in, and I hope everyone has a great rest of their day.